Welcome to the Explainer. Today, we're going to crack open one of the most powerful and honestly most misunderstood forces in modern finance, the private equity fund. We're going to deconstruct it piece by piece so you can see exactly how this thing ticks from the inside out. I mean, it's a huge question, right? How do you buy a multi-billion-dollar company? It's not like you can just, add a corporation to your online shopping cart. It often starts not with a single person's checkbook, but with an incredibly powerful financial engine that's built for exactly this purpose. And that engine is a private equity fund. Think of it as a massive, specialized war chest. It gathers a huge pool of capital, not for day trading stocks, but to make these enormous, privately negotiated investments, like buying up entire companies. All right, so how does this all actually work? Here's our game plan. First, we'll look at the PE machine itself. Then, we'll meet the key people involved. After that, we'll get into the fund's actual blueprint, see how the money works, and finally, we'll get into why this whole setup is so incredibly important. Okay, first things first, what exactly is this private equity machine? I mean, what is it designed to do that a regular investment fund just can't? At its core, it's a fund for investing in things you can't just find on the public stock market. We're talking entire companies, promising startups, huge real estate portfolios. And the key difference here is that these investments are illiquid. That's just a fancy way of saying you can't sell them tomorrow with the click of a button. Nope, this is a long-term commitment. So who's actually running this whole operation? Well, if you peek under the hood, you'll find that everyone involved fits into one of two main groups, and they each have a really different job to do. On one side, you've got the limited partners, the LPs. These are the big money players, pension funds, university endowments, the ones providing almost all of the cash. But here's the key. They are passive investors. Then you've got the general partner, the GP. This is the private equity firm itself, the team of experts who actively manage the fund and make all the critical decisions. The bus analogy really works here. The LPs bought the tickets, but the GP is driving the bus and deciding exactly where it's going. Now that we've met the players, let's pull out the blueprints and see how this whole thing is actually built. How do these LPs and GPs really connect and operate together? Right at the heart of the operation is the fund itself. Legally, it's usually a limited partnership. You can just think of this as the container, the legal box that holds all that money from the LPs. And a really important detail is that it's a fixed life vehicle. It has a built-in timer, usually around 10 years, which gives it a deadline to find, grow, and then sell its investments. Okay, this diagram might look a little busy at first, but it's pretty straightforward if you just follow the money. See up there? You've got the limited partners. They're the ones committing all that capital into the fund. And then, running the show, you've got the general partner, who controls that fund and calls all the shots. Now, here's a subtle but important detail. The GP often sets up a separate but affiliated company called the manager to handle the day-to-day operations. For our purposes, just think of the GP and the manager as the same team wearing slightly different legal hats. Their one job is to take the fund's capital and invest it in those portfolio companies you see down at the bottom. So we have the structure, we know who does what. Now for the big question. How does everyone get paid? Specifically, how does the general partner, the one doing all the work, actually make its money? Well, it breaks down into two main streams. First up is the management fee. This is usually around 1.5% to 2% of the total money committed by the LPs, and it's paid every year. This fee goes to the manager to cover, well, everything. Salaries for the investment team, office space, travel, legal fees. It's basically the budget to keep the lights on and run the entire operation. The second part, and this is where the real money is made, is carried interest, or just carry for short. This is the GP's share of the fund's profits, typically a whopping 20%. But, and this is a huge but, they only get paid after the LPs get all their original investment back, plus a minimum profit. So the carry, that's the grand prize. It's the ultimate incentive to hit home runs. So, if you remember one thing, remember this difference. The management fee is a steady, predictable payment for running the business. Carried interest, on the other hand, is pure performance pay. The GP only gets that big check if they make their investors, the LPs, a lot of money first. No profit, no parry. It's as simple as that. All right, let's zoom out for a second and ask the big question, why? Why this specific design? Why go through all the trouble of setting up these separate entities and fee structures? Well, it all comes down to a very deliberate strategy. This whole structure is engineered to do a few key things. Because it's a closed-end, fixed-life fund, The GP has a stable pool of long-term capital to work with. They don't have to worry about investors pulling their money out at a bad time. Giving the GP full control empowers the experts to make quick, decisive moves. But most importantly, the whole system is built around one central idea: alignment of interests. That carried interest ensures that the general partner gets rich only if the limited partners get rich first. And that right there brilliantly illustrates both the core genius and the core tension at the heart of private equity. The structure aligns the fund manager with its investors perfectly. But it leaves us with this critical lingering question about its wider impact. What happens when maximizing profits for the fund doesn't perfectly align with the long-term health of the companies it owns or the people who work for them? That is a question for another day.